Hi everyone, in today's episode, we're going to address the question of, have investors missed the mark to be buying in this market? And is it time for a pullback? Stay tuned. Hi everyone, welcome back. My name is Isaiah Rial, host of the Real Sense Retirement Show. In today's episode, I want to address what I've been seeing a lot in headlines recently. So if you've been watching or reading the news, we've seen a lot of headlines just like this. And what they're telling us is that, you know what, maybe a possible market correction is happening soon. Maybe a pullback is happening soon. A lot of negative news out there because stock markets have gone so high that, you know what comes up must come down, right? What's going to happen? There has to be a pullback. That's what a lot of the news has been saying. So what I typically do is, you know what? I don't want to look at what the headlines are telling me. Give me the numbers. Give me the facts. What's the data telling us of what's happening within the stock market? And so what I want to share with you today is one indicator that I use, and it was created by Dorsey, Wright, and Associates, and it's called the average weekly distribution of S&P 500 stocks. So what Nasdaq, Dorsey, Wright does is they calculate this on a daily basis, so it changes from day to day. And what it is an indicator that plots the averages of the overbought and the oversold territories of all the different stocks within the S&P 500. And so this is an important chart, and there's some important numbers here. The first is normalization. So within this chart, what is a normal reading? A normal reading is going to be close to zero. If it's overbought, it's going to be positive. If it's oversold, it's going to be negative. But if it's close to that zero mark, that means we're in positive, healthy territory for the stock market when it comes to being buy and being sold. We're in a normalization period. However, we are not in that territory right now. Let me explain. We are in extreme overbought territory. In fact, this is the 24th time this has happened since 2003. The reading right now on the average weekly distribution for the S&P 500 stocks is at a positive 40%. It's only happened 23 other times besides now since 2003. And so what does that mean? What does that tell us? Well, historically speaking, that means that the S&P 500 is overbought. It's been overbought for quite some time. And as a follow-up, historically, this is a level where we start seeing a top in the indicators, and we start seeing a normalization pullback to the mean, back to that zero level. So that poses the question, what does that mean for actual stocks? And also, too, what does that mean for the stock market as a whole for the indexes? Well, let's talk about that. So normalization back to normal, back to zero, back to that curve can happen typically two different ways. And this is according to Dorsey, Wright, and Associates. The first way it can happen is that the market can enter a consolidation period and have a pullback. So that's where we have a minor stock market correction or a pullback. And that often gets us back to normalization of the curve. That's the first way. The second way it can happen is that the market can continue to rally, so it can continue to go higher, but it's going to happen at a slower pace. So recently we've been seeing it actually happen pretty quickly. The second way it can happen is it does continue to go up, but it's going to be slower. And by going slower, it's going to allow it time to get back to normalization. So those are the two ways it can typically happen. Interestingly enough, besides this moment right now, the previous 23 times this has happened, on average, in a 1 month, a 3 month, And in a 6-month period of time, the stock market's been positive. If you average all these times up, it's been positive. So, that goes back to the headlines that we were reading is, hey, you know what? These headlines may not be as scary as we think. And in fact, the numbers are telling us something a little bit different. And on top of that too as well, it goes contrary to what people are saying is that we need to have a massive stock market correction for us to get back to normal. Not so fast. So let me share with you some data points here from this information. Because I know there's some people out there probably negative Nancy's that, you know what, Isaiah, you said on average, there has to be times that it's been negative. Well, there have been some times. And let me share with you how rare that has been. In a 1-month period of time, so when this indicator got to 40%, after a 1-month period of time, in the last 23 occurrences this has happened, only 6 times, 26%, have we seen the stock market, the S&P 500, be negative, be lower than where we were when we hit that 40% mark. Moving further, after a 3-month period of time, so once we hit that 40% marker, 3 months later, only 4 occurrences in those 23 times that we've been at this number. 17% of the time have we seen over a 3-month period of time the S&P be lower than where we were 3 months back, be in negative territory. Taking that a step further, over a 6-month period of time, so once we got to that 40% marker and then you go 6 months later, only once, 4%, one time out of that 23 occurrences have we seen the S&P be negative, be worse off than where we were when we hit that 40% marker. And so the bottom line here is that this is a short-term indicator. It doesn't predict long-term trends, but short-term. It does tell us that these readings are going to be overbought, so we may have to see a pullback here at some point in the near future. But historically speaking, it doesn't tell us that the end of the world is near, a stock market correction's happening. Actually, it's the complete opposite. It tells us that it's a vote of confidence, that the stock market's not done just quite yet. It looks like we're going to be in positive territory for some time. Of course, numbers aren't always right, but historically speaking, these numbers telling us that, you know what, we're in pretty darn good shape still. There may not be a market correction. And for one last negative Nancy comment, because there's probably some still people out there saying, well, Isaiah, there's still been some negative occurrences. In those dark days, in those dark years, 2000, 2001, 2002, so during the dot-com bubble and the recession, and then in 2008, we did not see this 40% marker occur. So for those that still think, well, a correction can happen, a crash can happen, in those very, very bad years that we've seen in the stock market, in 2000, 2002, and 2008, we did not even get close to this 40% marker in the overbought territory. So, becoming overbought isn't such a bad thing. In fact, it's actually a vote of confidence. But however, it's important just to know that it's not a good time to be buying stocks that are overbought and also to expensive levels. Now, as we observed through the years, and Dorsey, Wright & Associates says this too as well, stocks need to normalize, and that can be when we see a great and attractive time to be putting more monies into specific investments. So again, be specific, make sure you have the right sectors in place for yourself, the right investments, but these could be some good buying opportunities coming up here in the not so distant future. So I just want to share it with you that, hey, data doesn't tell us all doom and gloom. It looks like it's going to be positive here for some time. That's what the data is telling us, and so I wanted to share that with you. If you have any questions, if you have any thoughts, please feel free to let me know. Give me a call, message me, comment. I will be going into more detail about this topic in my upcoming podcast episode, so stay tuned. Please subscribe to my YouTube channel, podcast. I look forward to talking to you soon. Thanks so much. Have a great day. Take care. Bye-bye.